Before I start, I'd like to say a quick thank you to our sponsor, Fidelity International. You can find out more about them at fidelity.co.uk/money to the masses. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. And what a week it's been since the last episode. In fact, you would have seen headlines saying it was the worst week for stock markets since the financial crisis. Now that's going back almost 12 years. And that's because the stock market tumbles that had started around the sort of 19th and 20th of February continued into the back end of last week. And actually we had a bit more of it at the start of this week, which I will come back onto a bit later in this episode. So we had the worst week since the financial crisis. What that means is that the S&P 500, for example, is down more than 10%. That's correction territory. A correction, if you remember, is a 10% fall from a recent high. So that fell down below the 3,000 level. Now that was quite a negative sign to break below the 3,000 level, which was a key level of support on the S&P 500. Got a lot of people spooked. The FTSE 100 ended up down around about 13% at its worst. The S&P 500 actually was down 15% at its worst point intraday. We had the German DAX down around 14%. So you can see it was something that was repeated across stock markets globally. Now, one exception, which interestingly you've not probably heard in all the investment headlines and all the sort of hysteria that's been around markets in the last week, is that China has actually rallied. The stock market in China is up only about 1% since around about the 19th, 20th of February, but it has rebounded from the lows. If you recall, the outbreak of the coronavirus started in China, the markets absolutely tanked in China, and since then they've started to rebound. So there is a question, is it a roadmap for what's going to happen in the rest of the world when the fear levels actually recede? But if you look at other assets, so the US 10-year Treasury yield has actually plummeted to below 1%. It was at 1.33 if you remember last week, and it had fallen from about 1.6. To fall below 1% is a historic low. We're talking about going back over 100 years. That's how incredible this is. And it is really flashing an indicator that it's expecting a recession, particularly in the US and globally probably. So perhaps it's not surprising then that the VIX, the fear index, the measure of the volatility on the S&P 500 in the future, so it's called the VIX, the fear gauge actually leapt. It was in about the mid-20s the last time we made this video, but it's actually got above 30 and it's actually headed towards nearly 40. It's pulled back, it's going up and down, but any time it's above 31, it's a bad sign for equity markets, particularly when you combine it with the movements in other asset prices, particularly the 10-year US Treasury yield. So we're at a point now, it was almost a complete capitulation by investors globally as fear took over, as people panicked about the impact of the coronavirus. Now, interestingly, this week also marked the 5th anniversary of me running my live 50k portfolio for 80/20 investor members. So that is the portfolio where I invest live. I tell you what funds I buy and what funds I sell and when I do it, to show people how to run their own money and how they can do it. Now, that portfolio reached its 5th anniversary on Tuesday, and the portfolio is up over 33% in that time. Now, to give that some context, if you took the mixed shares sector, which are basically the equivalent multi-asset funds that exist out there, so the 40 to 85% share sector, then if you rank those over that sort of 5-year period and see how their performance was, then my portfolio would be in about the top 85%. Now, bear in mind that that was from a standing start. All funds back 5 years ago, the market was all-time highs. No one knew what would happen, whether the markets would crash, what to invest in. It's all about following a process. That's how I managed to do it. And don't forget, over that time, the equity content of my portfolio has risen and fallen. It's been as low as 28% at the worst point of the 2018 sell-off. If you bear that in mind and take into account the sector which has the exposure to equities of 20 to 60%, so those two key multi-asset sectors, and you rank their performance over 5 years, then my portfolios outperform 90% of fund managers. And what that does is that just emphasizes to people is that you can run your own money. You do not have to necessarily give your money to an expensive multi-asset fund. But if you want to know more, of course, you can take out a free trial of 80/20 Investor. Now, if you think about what's happened since the coronavirus outbreak, now my portfolio has held up pretty well relatively to others. So taking those examples again, that sort of 40 to 85% share sector, that equivalent multi-asset sector. Now, over the 200 plus funds in there, the average fall over this outbreak has been about 7.5%. Now, my portfolio is only fallen about 5%, pushing it in the top 10% of funds in terms of preserving capital. So the reason I've been able to do that is because my portfolio was positioned defensively, and that was based around the momentum that was there at the time, because the virus has just really emphasized what was already a concern in the background of a slowing global economy. So those things I've been talking about, defensive, so REITs, utilities, were starting to outperform anyway. The rest of the market was focusing on some of the tech stocks and all those interesting growth stories, but overlooking some of the defensives. And the defensives have just continued to perform or outperform during this sell-off as people have become focused on the impact of the coronavirus on the global economy. So that is why my portfolio has been able to preserve capital. It's not that I can predict the future, it's just following a process that when we get a black swan event like this, that gives you a better chance of trying to preserve that capital and outperform other funds and other fund managers. But what this period is really interesting for is there are a lot of lessons you can learn if you watch how asset classes move. So in the last 10 days, what we've seen is equity markets sell off. We've seen bond yields plummet, so that means bonds are rallying. We've seen gold rally, but we've also seen things like the gold price fall and slump into the end of last week. In fact, it fell and ended up around about 3.5% down on a week, which seems a bit odd when you think about it. When the market is fearful, people tend to buy gold. So why did it happen? These are the sort of things you want to look out for, because it helps you understand how markets work, the dynamics, and how perhaps a sell-off might unfold. And the reason the gold price fell, which I won't go into too much detail, is because of margin calls. So now where you have investors who hold their investments through a brokerage, then that brokerage might actually call for them to hold a bit more capital because their investments have fallen so much in value. And in panic, what people do is they sell the most liquid assets and the things that may have gone up. And in this case, that was gold. So that's why, if you looked at last Friday, the gold price plummeted alongside the US stock market plummeting. And equally, defensive sectors underperformed on that day and the day before, which seems a bit odd in a market that is fearful and worried about economic slumps, that defensives would underperform. So things like REITs and utilities on the day. And that's because investors needed to liquidate other investments so they could get their hands on the money. And that included, as I say, gold and defensives. But of course, this week, the story's changed. Those assets have now rallied as people have become a little bit more optimistic about markets, that we're not going to have a 40% crash, but they're still worried about the economic growth in the US and globally. So seeing these movements is interesting. Don't let those lessons go to waste. Watch them, see how currency markets move, see how commodity markets move, and see how equity markets move, and particularly in relation to each other. So after last week's crash and the fear, we've had a bit of a rebound at the start of this week. And that was because some people think the bottom's in the market. That means that it's at a point it was so oversold that we're going to bounce from here. And part of that optimism came from central banks globally saying that they were planning or were willing to support the market by any means necessary. So to the equity investors out there, that was music to their ears. That means lower interest rates for longer, possibly quantitative easing. So markets started to react. They started to price in the fact, in particular, the US Federal Reserve would cut interest rates during the month of March. Now, what actually happened is that while some central banks started to make more noises than other, we had the Australian central bank actually cut rates. Then the Federal Reserve almost went, hold my beer, and suddenly did a 0.5% interest rate cut that surprised the market on Tuesday. In other words, there was a big red panic button that Jerome Powell smashed pretty hard. And of course, at first markets thought that's going to be brilliant news. That means equity markets will rally. Because don't forget, over the last decade since the financial crisis, the reason that markets have largely been pushing upwards, particularly stock markets, is because of liquidity from central banks. So the simple logic is, if the Central Bank of America is going to cut interest rates, then stocks should rally. And of course it did initially, But then the stock market turned around and fell and almost closed down 3% on the day. So why was that? And the reason is an element of that, what is it they know that we don't? But if you go back and look at the last time that central banks hit the panic button and made emergency interest rate cuts, then that is back in the financial crisis, and particularly around October 2008. And we know what happened after that. We had the collapse of Lehman Brothers, and equity markets actually then turned around and started to slump further. So the initial sell-off led into a bigger crash, and that is the danger that we should have now. In fact, having an interest rate cut by the US Federal Reserve has caused some people to think that we might have increased the odds of a bigger crash. It's not to say that it will do, but you've got to also think about what would an interest rate cut do. In past crises, boosting liquidity, so in the financial crisis, the credit crunch, that helped things because it helped boost demand. But with a virus, what you're actually getting is a supply side disruption, so that people aren't being able to make things or deliver services that they would normally do. But also the demand is disappearing because people maybe are quarantined or not wanting to go places, go to restaurants and things like that. By boosting liquidity, you can't make or fix those things, particularly on the supply side. So will the Federal Reserve's interest rate cut actually do anything? Have they effectively thrown their chips in too early? That's what people are worried about. So that's why the market has been slightly nervous. We've pulled back a bit again, and we're around that 3,000 level on the S&P 500. So it will be interesting to see what happens in the days and weeks ahead. The US Federal Reserve is probably likely to cut interest rates further. We'll probably see the Bank of England do something, although they have less room to, because don't forget the Federal Reserve increased interest rates when the economy started to pick up. The Bank of England didn't really do that, so they've got less firepower. But don't forget, all these central banks can print as much money as they pretty much want. So we could see a lot of that in the future, which ultimately might therefore buoy the economy and the stock market. A bit like what we've seen in China, because don't forget, the People's Bank of China have done exactly the same. So they've boosted liquidity, and so far we've seen their stock market turn around. And like I said earlier, will that happen in developed world markets? So one other interesting thing to ponder is what would happen in a lower interest rate environment. Which type of investments will perform well? Because if we've suddenly now shifted into that environment where rates could be cut aggressively, then what sort of investments will do well? Well, bonds should do well. Equity markets should get a boost, but it'd be particular equity. So it'll be things like, again, REITs, the real estate investment trust, because of the income they produce. It will probably be utilities, slightly boring, but again, producing steady income. They will likely rally. The things that won't do very well are things like financials, because banks aren't able to make as much money on their lending if interest rates are going down. So all these dynamics we'll probably talk about in the coming weeks, but try and spot them if you can when you look at that stock app on your phone, seeing if you can see any of these patterns start to emerge and you see some of these rotations within equity markets. So that is it for this week on Damien's Midweek Markets. As ever, do look at our Facebook group, because there's been a lot of questions around our Facebook group about this sell-off, what to do, what people are doing. A lot of people being interested in buying the dip, etc. So some really good views being shared in there. So go and join that. You can go to facebook.com/groups/money to the masses. Also, don't forget you can contact me on Twitter, money to the masses with the number 2, Instagram, and you can also get us on YouTube. Don't forget to subscribe to our YouTube channel.